Hello, I'm Nathan Kubik, and thank you for joining us for the end of the second quarter Transform Wealth Capital Markets Review. I hope everyone is enjoying their summer. Having progressed meaningfully towards herd immunity, life is starting to feel a little bit more like it used to. Today, we'll be discussing recent events, what we are currently observing in the financial markets, as well as a number of other noteworthy influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. In the second quarter of 2021, the equity markets continued their rally for a fifth straight quarter, with the S&P 500 and NASDAQ reaching new record highs. Entering the third quarter, we are seeing forward-looking economic indicators that are continuing to improve. Corporate earnings are forecasted to continue their upward trajectory. Interest rates remain attractive for economic growth, but difficult for income-yielding securities. Increased inflation has become an area of concern, though the Federal Reserve and the markets believe that this is not a longer-term issue. Market valuations also remain high, but do appear to be improving. Details of any tax changes remain unknown. However, it is likely that there will be increases at some level. And while the U.S. is on its way towards a full economic recovery, many other areas in the world are not rebounding so quickly. For the past year and a half, the coronavirus has been the primary driver within the markets. As seen in these charts, the U.S. is breaching through the levels needed for herd immunity. Over half the population has been vaccinated, and over 70% have been vaccinated or infected. Additionally, these numbers consider the entire U.S. population and also includes those under 18 years old. As we discussed last quarter, the percentage of those vaccinated for ages over 18 is considerably higher. While the aftermath of COVID remains in focus, going forward, the markets have returned to a focus on the fundamentals of economic indicators and the execution of corporate growth initiatives. Economic growth has rebounded in a massive way, which can be seen in the chart on the left. While we are not quite back to pre-crisis levels, we do see an accelerated slope to the growth of GDP. It is our expectation that we will overtake previous levels in the next quarter or two. And the markets have priced in this growth. And so far, the previous market's expectations of economic growth are indeed appearing to have been correct. In addition to strong GDP growth, we are also witnessing some meaningful data from the job market. Unemployment levels have been reduced dramatically, but they do remain at higher levels than we would like to see in this type of economic expansion. Perhaps confusingly, the number of openings in the job market are at extremely high levels. You might ask, how is it that we still have higher levels of unemployment with a record high amount of demand for new employees? The answer to that question has a number of explanations. However, the primary driver is that of the enhanced unemployment benefits set forth during the pandemic. Many potential employees are making more through unemployment benefits than they will by returning to work. These benefits are set to expire in September, and we suspect that these openings will begin filling as we draw closer to that date. Due to this disconnect between job openings and job seekers, we are seeing some wage inflation. That, taken without the context of the prolonged employment benefits, would be a bit alarming. However, the markets appear to believe that this is understandable and transitory, given the unemployment benefits backdrop. And that brings us to one of the major concerns in the market today: inflation. Recently, we have all witnessed inflation at one level or another. During this past quarter, the inflation indicator known as CPI, or the Consumer Price Index, has jumped to its highest level in over a decade, surging over 5% year over year. As you know from the past market's outlook, this has been a key focus of ours. Continued higher levels of inflation growth has the potential for a number of negative impacts to the economy. Some of those include a corresponding spike in interest rates, which would impact bond prices, corporate debt, corporate earnings, a jump in mortgage prices, and a decline in our purchasing power. Now, the Federal Reserve and the markets do not believe this is going to be an extended period of higher inflation levels. Instead, they are using the word transitory to convey their expectation that this is a short-term impact based on pent-up demand, higher levels of discretionary spending, a recovering supply chain, and the employment issues we just discussed. We at Transform Wealth also believe this to be the case and expect inflation to move back towards targeted levels in late 2021 or early 2022. That said, we also believe that there are some scenarios which could extend this inflationary period. To that end, we have actively positioned some inflation risk dampening strategies in each of our portfolios. The other leading concern at the moment is that of taxes. We discussed this at length during the last market's outlook, but we wanted to reiterate its importance. If you missed last quarter's discussion, I'd encourage you to go back and listen to the outlook, starting with a section taking place at the 4-minute mark. For the past several quarters, we have been discussing the expected rapid expansion of corporate earnings to justify the higher stock valuations that we have been seeing in the equity markets. Well, those higher expectations appear to have been justified, as corporate earnings have greatly exceeded those high expansion expectations. In the chart on the left, consider the light blue earnings estimates levels. The first two bars are the first and second quarters of 2021, which are meaningfully higher than they were forecasted to be just one quarter ago. In fact, when considering the year-to-date 14.4% performance of the S&P 500, we see that valuation multiples have indeed declined and that earnings growth was actually up almost 20% over the past 6 months. That recent decline in valuation multiples can be seen on this slide. Put simply, corporate earnings are growing at a meaningful level. So much, in fact, that the valuation metrics are moving back towards normative levels. It is important to note that we do remain at quite elevated levels, but we are moving in the right direction, even with high equity returns. Going forward, continued earnings growth will be critical to justify current market valuations and to bring valuation metrics back to truly normative levels. This is indeed what the consensus of analysts believe will occur, and time will tell. That expectation can be seen in this chart by the green line, which shows the next 12-month forecasts for the earnings per share of the S&P 500. The blue line is the S&P 500. You can see how the movement of the S&P 500 is correlated to its expected earnings. It is important to understand that the performance of the S&P 500 is directly tied to the earnings and expected future earnings of its constituents. When considering those earnings expectations and valuation metrics, one must understand that the S&P 500 considers the weighted average of the large cap stock market as a whole. Some of its underlying companies have valuations that are building in incredibly high levels of earnings growth expectations, while others are assigned valuations with expectations of no or even negative growth. In this chart, we consider that disparity. This chart weeds out the top and bottom 20% of extremes and considers the disparity between the remaining 60% of stocks in the S&P 500. Even after weeding out those extremes, we still see a wide level of disparity. Typically, during these wider periods of dispersion, active management has a greater opportunity for outperformance, as valuation dislocations can occur, as well as the opportunities for more impactful earnings surprises. And there have been many corporations with positive earnings surprises to date. Looking at the stock market recovery, we can see that we have blown past pre-pandemic levels and that the domestic markets are at record highs. With the developed international markets realizing a comparable decline from the pre-pandemic peak, the U.S. has greatly surpassed that of the rest of the developed world. In fact, From the bottom, the US has outperformed the rest of the developed world by over 20%. And this domestic outperformance is nothing new. And while we are always looking for compelling reasons to add more international exposure, we have intentionally minimized our international exposure for many years now. The US stock market has consistently outperformed the rest of the developed world for over 13 years now. From a style perspective, small cap stocks have had a great start to the year. We did add some small cap exposure to our core equity model back in November of last year, for which the model has benefited. Moving to a growth versus value discussion, if you remember, we had been positioned with a value tilt towards the end of last year and into the beginning of this year. We then moved towards a neutral stance and are now positioned with a tilt towards growth. While the year-to-date number here does show value outperforming for the past 6 months, over the past 3 months, large cap growth outperformed large cap value by about 3.5%. It's too early to say that this is a longer term shift in the style in favor, but it is worthy of watching, especially when considering the earnings growth expectations that we discussed earlier. And here we look at our current style weightings. As you can see, we are not aggressively overweight growth. Rather, we are simply tilted and vigilantly watching this trend as it emerges. We also see a greater dispersion in performance and a corresponding opportunity at the sector level, and even more so at the subsector level. Here we consider the performance of the sectors of the S&P 500. Our current overweights in our core equity model are energy, financials, industrials, and technology. Cyclical sectors have had a nice start to the year, driven by the economic recovery, infrastructure focus, and future growth expectations. Energy stocks have rebounded from the oil crisis last year, and energy prices have climbed meaningfully. One other sector that's positioning is worthy of note is that of financials. On one hand, low interest rates make it difficult for some financial companies to create an interest rate spread, so this could be a challenging time for them. On the other hand, if inflation was to become an issue, interest rates would likely rise, and those same financial companies would benefit from an increased opportunity for that interest rate spread. Financials are typically thought of as an inflation hedge within equity portfolios. While we are in the camp of expecting this inflation to be transitory, we are using this sector as an inflation risk dampener should the unexpected occur. This is but one example of how we utilize sectors to shift the risk exposures we perceive in the market. Even if we don't believe the risk to be overly likely, we will often adjust our risk exposures for the case of it being a possibility. Looking at our sector weightings in our core equity model, we did have overweights to the top 2 performing sectors of energy and financials, but we also had underweights to the next 2 top performing sectors of real estate and communication services. We currently see some risk in real estate due to the valuations and interest rate risk exposures, and we intend on keeping this underweight. Regarding communication services, we own the companies that we like in this space, and while we have strongly considered adding to this space, we feel as though there are not currently any other candidates that meet our fundamental requirements. With a couple of coming tweaks from the investment committee, we do feel good about our current sector positioning moving into the second half of the year. And as mentioned earlier, we are focusing even more closely on the subsector weightings and individual securities fundamentals within this type of market environment. A similar story can be seen in our dividend equity model. This strategy has an inherent tilt towards large cap value, and we do believe that these types of companies have stronger fundamentals and that their valuation metrics also remain relatively attractive to the market as a whole. Like the core equity model, we also continue to hold a defensive portion within this model to the buffer cap strategy as well. As we are in a time period of incredibly low yields, the dividends associated with these companies, along with their strong fundamentals, should continue to look attractive and entice buyers as we move forward through 2021. We are also aware of the implications of inflation on dividend-paying companies and are thoughtfully positioning with this in mind. I will note that any tax changes do have the potential of causing us to shift our focus, but we currently feel well positioned going forward within this space. On the bond side of things, we have seen yields move back down a bit from the meaningful move we saw last quarter. International bond yields remain a pressure on U.S. rates, and the Federal Reserve's ongoing easing through bond purchases continues to hold rates at lower levels. This is particularly interesting when we consider our previous discussion on inflation. Clearly, the bond markets believe that the inflation we are seeing is transitory and that it will return to its previous low levels. This is a difficult time for fixed income instruments of all types, and we believe the prudent course of action is to be patient and a bit defensively positioned as we move forward in the expectation that rates can rise further. Looking at direction from the Federal Reserve, along with the market's expectations of changes to the Fed funds rate, we see an alignment in expectations. With that expectation of the Federal Reserve potentially raising the short end of the yield curve in later 2022, this further supports the expectation of transitory inflation, which is expected to subside. However, even with that expectation of inflation being transitory, we do not believe there is enough reward to stretch for a little bit of extra yield today at the risk of principal devaluation should there be a rise in interest rates. Thus, we continue to advise patience and a focus on total return. So in conclusion, given all available indicators and economic data, we continue to feel cautiously optimistic about what 2021 looks like. We feel strongly about the companies we currently own and the way we are positioned going into the next quarter. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented today. Take care, and we look forward to speaking to you soon.